This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to today's discussion. We're diving into the intricacies of the Federal Reserve System, specifically focusing on Section 2, Federal Reserve Districts. It's a crucial part of the U.S. monetary system and often misunderstood.
Indeed. The district structure is fundamental to how the Fed operates, influencing everything from monetary policy implementation to bank supervision. Many people don't realize the geographical aspect is so important.
Exactly. It's not just about dividing up the country, it's about tailoring the Fed's response to regional economic variations.
And that's where the nuance comes in. A one-size-fits-all approach to monetary policy simply wouldn't work given the diverse economic landscapes across the U.S.
So let's start with the basics. How were these districts initially established, and what was the rationale behind that process?
The initial establishment was handled by the Reserve Bank Organization Committee, a group comprising the Secretaries of the Treasury and Agriculture and the Controller of the Currency. They were tasked with designating between 8 and 12 Federal Reserve cities and dividing the continental U.S., excluding Alaska at the time, into districts, each with one reserve city.
And what factors guided their decisions in creating these districts? Was it purely geographical, or were other considerations involved?
It wasn't purely geographical. The committee considered the convenience and customary course of business. The goal was to create districts that made practical sense for the flow of commerce and financial transactions. State lines weren't necessarily followed.
So it was a pragmatic approach, prioritizing efficiency and economic realities over strict geographical boundaries. That makes sense. But the districts aren't static, are they?
Absolutely not. The Federal Reserve Board retains the authority to readjust existing districts or create new ones, although the total number is capped at 12. This flexibility allows the system to adapt to evolving economic conditions and population shifts. The addition of Alaska and Hawaii later required adjustments, for example.
Let's talk about the role of these Federal Reserve cities. What makes a city eligible to be designated as a reserve city, and what are the implications of that designation?
The initial selection criteria aren't explicitly detailed in the text, but it's clear that economic significance and strategic location were key factors. Being a reserve city meant hosting a Federal Reserve Bank, becoming a central hub for monetary policy implementation and banking operations within its district.
So these cities serve as the operational centers for their respective districts. This decentralized structure seems to be a key feature of the Federal Reserve System.
Precisely. It allows for a more localized understanding of economic conditions and a more targeted response to regional challenges. The decentralized structure helps avoid a situation where a single entity dictates policy for the entire nation, regardless of regional differences.
The text also mentions the requirement for national banks to become member banks of the Federal Reserve System. Can you elaborate on that process and the implications of membership?
National banks were required to subscribe to the stock of the Federal Reserve Bank in their district, a percentage of their paid-up capital and surplus. This ensured a degree of ownership and participation in the system by the banks themselves. It also made them insured banks under the Federal Deposit Insurance Act.
And what were the consequences for national banks that failed to comply with these requirements?
Failure to comply could result in the forfeiture of their rights, privileges, and franchises under the National Bank Act and the Federal Reserve Act. This was a significant incentive for compliance. The text also outlines individual liability for directors who participated in or assented to violations.
The document mentions the possibility of public and government stock subscriptions if bank subscriptions were insufficient. How did that mechanism work?
If bank subscriptions were deemed insufficient, the organization committee could offer public stock subscriptions under specific conditions. There were limits on the amount an individual or corporation could hold. If even that proved insufficient, the committee could allot stock to the United States government, paid for from the Treasury.
So the government had a backstop mechanism to ensure adequate capitalization of the Federal Reserve banks. This highlights the government's role in maintaining the stability of the financial system.
Exactly. It underscores the government's commitment to the system's success and its willingness to intervene if necessary to maintain its stability and effectiveness.
The text also addresses voting rights and stock transfers. What are the key provisions regarding these aspects?
Only stock held by member banks carried voting power. This ensured that the banks had a voice in the governance of the Federal Reserve System. The Board of Governors was given the authority to regulate stock transfers.
This allocation of voting rights reflects a balance between private sector participation and public oversight. It's a crucial aspect of the system's governance structure.
Precisely. It's a carefully designed system to ensure both accountability and effective operation.
Finally, the document specifies a minimum capital requirement for Federal Reserve banks and clarifies the relationship between the establishment of reserve districts and the existing status of reserve cities. Can you explain these provisions?
Each Federal Reserve Bank had to commence business with a minimum subscribed capital. The designation of reserve cities and districts didn't automatically alter the existing status of reserve cities, except as it related to the amount of reserves banks could hold with approved reserve agents.
So the creation of the Federal Reserve System built upon, rather than replaced, existing banking infrastructure. This phased approach seems to have been a deliberate strategy.
Yes, it was a gradual transition, integrating existing structures into the new system. This minimized disruption and facilitated a smoother implementation of the Federal Reserve Act.
The document mentions amendments to the original act. How has the Federal Reserve Act evolved over time, and how have these changes impacted the district structure?
The Act has undergone several amendments since its inception, reflecting changes in the economic landscape and the evolving role of the Federal Reserve. These amendments have refined the system's operations, but the fundamental district structure has remained largely intact, demonstrating its enduring relevance.
So while the details have been adjusted, the core principle of regional representation and decentralized operation has persisted. This speaks to the effectiveness of the original design.
Precisely. The adaptability of the system has been key to its longevity and success in navigating various economic challenges.
Let's discuss the practical implications of this district structure. How does it affect monetary policy implementation?
The district structure allows the Federal Reserve to gather localized economic data and tailor its monetary policy responses to regional needs. For example, a district experiencing rapid growth might require different policy adjustments than a district facing economic downturn.
So it's not a one-size-fits-all approach. This localized approach seems crucial for effective monetary policy.
Absolutely. It allows for a more nuanced and effective response to economic fluctuations across the country.
How does the district structure impact the Fed's supervisory and regulatory functions?
The district Federal Reserve banks play a significant role in supervising and regulating member banks within their respective districts. This localized oversight allows for a more thorough understanding of individual banks' operations and risks.
This localized approach to supervision seems to enhance the effectiveness of regulatory oversight.
It allows for more targeted interventions and a more proactive approach to risk management.
Are there any challenges associated with the district structure, and what are some potential future considerations for its evolution?
While the district structure has proven effective, challenges remain. Maintaining a balance between regional autonomy and national consistency in policy implementation is ongoing. Future considerations might include adapting to further technological advancements and evolving economic dynamics.
So it's a dynamic system that requires continuous evaluation and adaptation to remain relevant and effective.
Precisely. The Federal Reserve must continually assess the effectiveness of its district structure and make adjustments as needed to ensure its continued success in supporting the nation's economic stability.
In closing, what is the overall significance of Section 2 Federal Reserve districts in the context of the broader Federal Reserve System?
Section 2 lays the foundation for the Federal Reserve's decentralized structure, enabling a more nuanced and effective approach to monetary policy, supervision, and regulation. It's a cornerstone of the system's design and its continued success.
So it's not just a historical artifact, it's a vital component of the modern Federal Reserve System.
Absolutely. The district structure remains a critical element in the Fed's ability to effectively manage the U.S. economy.
That was a great discussion. Thank you for your insights.